This is the perfect example of how you don't want to make decisions about investment, where people will panic, sell, or buy the wrong stocks because of similar information. You want to be able to do research that is based upon facts, not stories.
The information provided here is for general informational purposes only and should not be considered an individual recommendation or personalized investment advice. The information in this material is not intended for tax or legal advice. Please consult a legal or tax professional for specific information regarding your individual situation.
Good day. This is Neil Gendreau once again, your money doctor. And today's topic for this podcast will be common mistakes that investors make. To start off with, there are some very general causes to that. Most common causes are lack of knowledge and emotions. I mean, those are the common denominators for what causes people to get off track. And as far as the emotions go, is that people are more often driven by fear and greed, and also following crowds, following the herd, rather than really engaging themselves so they become knowledgeable investors. Most importantly, what I find many times, not with everyone, but one reason why people come to me in the first place is they have no plan. They have no investment plan. They have no financial plan, let alone the fact that they don't have a financial plan. The investment plan they're totally in the dark with too, and that's just a small component. So what you need first and foremost as a foundation for any of this is a plan, which is why I want to reintroduce my brochure that I created recently. And if you haven't taken advantage of this yet, please consider doing so. Is you can actually order a copy for yourself at no cost to you. I'm not sure if I emphasized that the first time. What is financial planning and how does it help? It helps by having you have a plan. In other words, knowing what you're doing. So I encourage you to order a copy of this, because what this does is it kind of gives you a general outline of what my overall practice philosophy is and how I work with clients, and most importantly, how it helps them. So that could be a very useful start for you in terms of getting acquainted, in addition to these podcasts. So I highly encourage you to do that. You can just email me in the links below and request a copy. You can request a copy either electronically, or you request a copy of the actual physical handbook, which is great because with the physical handbook, you always have a quick and immediate reference to it without having to scroll your computer. You can also share this with a friend or a relative or whomever. But most importantly is that if you find yourself or you find others not following the fundamental concepts of financial planning, you can take the opportunity to whack them over the head with it. So that's my advice to you. Please consider doing that. And that can be a great way for you to start getting more familiar with the idea of financial planning. And also, as it relates to investment planning, let's start by talking about the fundamentals. The fundamentals are really what's important about investing. I'm going to emphasize that throughout this presentation, but the fundamentals themselves have fundamentals. So in other words, how many investments are there? What are the types and how do they differ? And which one is best? That's the prevailing argument. Now, this way, investing in stocks is the best way to invest. No, investing in real estate is the best way to invest. No, investing in crypto is the best way to invest. What you have to understand about any of these methodologies is that they all have pros and cons. So you want to look at them in isolation as being the only way or the best way to invest, but you have to look at each of these different categories of investments as tools. You want to use this as a tool set to be able to choose and manage how you design your portfolio. And it helps you to understand the breadth of these different investments, because the more you know, the more effective you become as an investor. So what are the various fundamental types of investments? Well, the most obvious ones that most people talk about, including people like myself, are stocks and bonds. So what is a stock? A stock is simply an ownership representation in a publicly traded company. Of course, the number of shares you own determines the size of your ownership. A bond, on the other hand, is something that's issued by either a corporation or a government that represents borrowing. So in other words, it's debt that's issued by either of these entities, corporations or governments, to be able to have money to raise capital, to borrow, to be able to fund their operations. That's what stocks do too for these companies. When they issue stocks originally, the idea have a public presence, but also they obtain a very significant source of capital to greatly enhance their operations. The difference is that stocks represents ownership and no obligation to repay. You own whatever you have. So the value of that is based upon what the price dictates in the market. Whereas in bonds, there's always a promise to repay. So with bonds, the company or the government that issues them has an obligation to repay that loan back to you. Of course, there's also cash, which includes savings, certificates of deposit. Savings and certificates of deposit are actually just banks borrowing from the public as a way of obtaining capital so they can lend money back to the public at a higher interest rate. So savings and CDs are obligations to you from the bank based upon the money that you put in there for various reasons. And of course, governments can also issue short-term debt that are considered as cash equivalents, which include treasury bills, and even corporations can issue short-term debt, and that's typically determined or named commercial paper. There are also commodities, which has nothing to do with necessarily quote-unquote financial investments. These are tangible investments in very fundamental types of things such as gold, silver, oil, copper, natural gas. So the latter three, the copper, natural gas, and similar commodities of that are actually very essential in terms of we need to use these different ingredients to either heat our homes, drive our vehicles, or manufacture significant structures, okay? So there's such a heavy reliance upon these materials that they have not only trading in the economy, but there's also different contracts upon these commodities called futures, which enables either people to buy or sell contracts for the future delivery of such commodities at a specific price at a specific date and time. So the futures are used to be able to lock in prices either now or in the future, possibly either to generate income by the issuer or to be able to have a contract where they can lock in a certain price before the maturity date. There are also options, which are basically derivatives of stock investments. So likewise, an option is a contract to buy or sell a specific stock before a specific maturity date. The difference between an options and a futures contract is future contracts, once they expire, will trigger automatic delivery of that substance, whereas an options contract on stocks expire, and there may not necessarily be any delivery of those underlying stocks. Of course, most people are familiar with real estate. Most of you own your own homes, and people also buy it as an investment for rental income, for instance. And there's commercial or residential variants of that. Real estate can be actually owned physically, like you own a property yourself. You manage the property, or it can be owned privately as well. So in other words, there are private real estate investment firms called real estate investment trust that will manage those specific investments for you. And sometimes those real estate investment trusts are traded on the financial markets, just like any other stock might be. And then we have cryptocurrencies, which many of you also are familiar with. It has a lot of hype in the media. People are basically either obsessed or confused by the crypto markets. Basically, the most fundamental or most well-known cryptocurrency is Bitcoin, as we all know. So many people do own Bitcoin or trade Bitcoin, at least somewhat. Some people actually even use it as a mode of exchange. And there are some people who are devout followers and invest almost entirely, if not most all their assets in Bitcoin. So it varies. And of course, like I said before, this argument, what is the best category to invest in? All of them, or some of them, or some combination of it. It depends. There are pros and cons of each. And to be fair, each one of us has inherent biases in terms of the types of assets that we prefer to invest in, the ones that we like, the ones that we know most about. But the most valuable thing that you can do for yourself is to become acquainted with at least some, if not most or all these categories, to really educate yourself in terms of the pros and cons of all these investments, and most importantly, how to best be able to deploy those combination of investment asset classes that are best for you. So how do you determine that? How do you build a portfolio with all these options? This is where the confusion comes in for most people. Most people who do invest actually stumble upon these either as a matter of convenience or because they were basically indoctrinated or very well used to understanding these assets within their family. Like if you have family owned real estate, and then people automatically gravitate towards that. Of course, you can see and you can inhabit real estate as a physical investments like commodities, except that real estate is everywhere. And it's a structure that's permanent. It's not going to go away and it's not going to be burnt up or used out. So most people are at least equally familiar with real estate as they are stocks and bonds. And most people get into stock and bond investing, such as within, let's say, their retirement plans at work. So those might be the most prevalent investments, but as you become more financially sophisticated and as your knowledge grows, people will tend to use a much greater combination of these investment classes. There are also alternative investments, which might encompass any or some combination of these different categories that are managed privately, but may not necessarily be publicly traded. I'm going to hold off on the alternative investments for another time. Maybe our next podcast might get into that, because that's another whole ball of wax altogether. But I want to stick with the basics first. And so once you understand the basics, you're in a better position one way or the other with how to build a portfolio. When you build a portfolio with these different assets in mind, what you have access to, what you're most comfortable with, what you're most familiar with, the way that you develop a plan, the first part of your plan on a holistic basis is to be able to have a plan in the first place. And the way that you build a plan, most people just do it randomly, but if you're smart about it, you're able to design an asset allocation model. What asset allocation is, it's kind of like a scientific basis based upon Nobel Prize winning research that was conducted about 35 years ago by Roger Ibsen, William Sharp, and Harry Markowitz. And the whole idea behind this is that most people think that they can just randomly buy investments that they heard about or get a tip from a friend or a neighbor or a family member, and hopefully, if they're lucky, they might make a lot of money. Well, this is the whole thing that you're trying to avoid. Investing is not gambling, and this is the greatest distinction I can build. Some people don't really understand. Investing is based upon not only fundamentals, but it's been actually nailed down to more or less a science by this Nobel Prize winning research conducted by the people I just mentioned. Basically, what it suggests is that 91+% of the return of any investment portfolio can be best explained by the combination of asset categories that are used. So the combination of asset categories used will determine 91.5% of the outcome of your portfolio as it relates to return, that is the performance of it, whether or how much it grows, and also the relative degree of risk. Risk being defined as fluctuations in value. No one can predict the future, but what happens is that the longer period of time, the more predictable these various asset categories become, especially when studied in combinations of each other. Meanwhile, mentioning that 91.5% of investment performance is primarily defined by the asset categories used, this theory is highly academic, obviously. So it may not be perfectly correct, but it does have a lot of foundational application to how to most effectively build a portfolio that is most likely to work according to your expectations. Obviously, nothing is a perfect science, but what these statistical results show is exactly the fact that the more asset categories you use and the more variety of investments that you use, the more likely it is that your performance is going to be determined by the combination of those investments as a whole rather than any one particular investment, or rather than determined by when you bought something versus when you might have sold something. Okay? With that in mind, the biggest factor to consider, in addition to the actual diversification of your portfolio, is time. Because the longer the time, the more predictable that returns become for the vast majority of asset classes. So what you will see shortly is what's been referred to as an Ibbotson chart, named after Roger Ibbotson, one of the major contributors to asset allocation theory. And this chart is kind of like an oversimplification, but not exactly, of the relative performance of a few asset categories, specifically stocks, bonds, cash, and inflation over long periods of time, specifically since right around 1926, just before the Great Depression started. And what I do is I kind of affectionately introduce this to my clients when first discussing investments. And I show this to them and I ask, like a psychologist, what do you see in this chart? Kind of look at me quizzically, which is okay. It's almost like a Rorschach chart. But what I try to emphasize to them is, don't be shy. What do you think about when you see this? And it's quite evident to see that when you compare the performance of these 5 different investment categories, whether it's small cap stocks, large cap stocks, government bonds, treasury bills, or inflation, is that stocks have way outperformed over the course of this time. Now, if you think back to 1926 and what that entailed since then, including the Great Depression, World War II, Vietnam, the great inflationary period of the 1970s when we had a combination of us taking gold off the monetary standard and experiencing high inflation, especially with oil prices, for the next 10 or 12 years. Then we had the stock market crash in 1987 that sometimes you hear about. Then we had the dot-com bust of the early 2000s. Shortly thereafter, we had 9/11. Then we had the great financial crisis with the banks during 2008, 2007. Then we had COVID. So those were some pretty perilous times for the stock market. And so when people recognize those different periods of history, they tend to kind of like overemphasize the negative risk or the negative volatility that each of those periods had on the stock market. The stock is just one investment, but it's a really good example to use because it's an example of investment that does obviously have a lot of potential volatility to it. And people are afraid of volatility. It goes back to emotions, fear and greed. People love making money, but they don't like losing money. Now, the thing is, have you really lost money when market values decline for whatever reason it suggests, or is it just a temporary phenomenon? Why does, in fact, the stock market as a whole, despite its volatility, so significantly outperform government bonds and cash equivalents? This isn't rocket science, but people think that it is. It's not. What's really interesting about this chart is that when you look at it, it's a geometric graph, which means that the incremental values on the upward sloping axis, the y-axis, is in powers of 10, which means that we have to actually extrapolate this graph to its actual value. The graph would require a page the size of this office to be able to demonstrate the difference of value in each of these cases. So you see that small cap stocks from $1 in 1826 made like $64,000. Large cap publicly traded stocks made about $18,000, while government bonds made a paltry $128, and inflation turned $1 into 18. So people complain about inflation, but people ignore the incremental investment returns that you could earn with higher amounts of volatility. What's the difference? Time. So time tends to point towards embracing investment risk, not trying to avoid it. Doesn't necessarily mean you always have to pick the most quote unquote risky investments, because the investments that you select or build for your portfolio should be based on a sound set of fundamentals. Firstly, by the asset allocation model and what that might suggest for the level of risk that you're willing to assume, which combination of investments might be best based on that particular vector or dynamic. But also, what you have to look at is the quality of the underlying investments. Each of these investment categories might have much better fundamentals than others. And I'm not trying to be biased here. But for instance, cryptocurrencies like Bitcoin, yeah, they're very popular, but they have no intrinsic value. It means they're worth nothing other than what people are willing to pay for it. That being said, stocks and bonds are also worth, really, at the end of the day, nothing more than what people are willing to pay. But the underlying value of these investments are based upon very understandable metrics. So in other words, stocks, you're owning companies or shares of companies that have assets and people that generate value in the form of profits. So the value of stocks is based primarily on profits and profit growth, whereas the value of bonds is primarily based upon the eventuality of repayment, as well as the momentary or monetary interest that you receive every 6 months usually. So the point is that some investments have a more predictable foundation of determining value than others. Crypto has none. Futures, commodities rather, and futures too, will fluctuate based upon what people are willing to pay for that commodity, based upon whether there's a surplus or a shortage of that item. So when there's a shortage of oil or a shortage of natural gas, people will be momentarily willing to pay more for natural gas or oil byproducts like gasoline. And that's when you see your energy prices go up and people complain about it. But there's a reason. It's not because people are mean. It's because there's less to go around, because people are either producing less, or sometimes because in the event of a strong economy, the demand for any of these commodities might be so overwhelming that they can't keep up with the supply. And so prices have to go up. The opposite happens when people spend less. If there's a recession, then prices will go down. But it's not predictable. Unlike a stock where you know that every quarter, they're going to give you a report that says, this is how much money we made this quarter. This is how much money we expect to make next quarter. These are the reasons. And here's our insight in terms of what we expect for the next several months. You get a much more closely manageable track record for things like stocks and bonds than you do commodities, futures, or cryptocurrency. So it's a matter of risk and return. And the whole idea is to know what those parameters should be for your financial situation. That comes from having a sound plan. First, a sound financial plan, and then a sound investment plan to follow up on that. Now, the other item of note is that most people don't invest for the highest returns. A lot of them invest to manage risk, right? Well, here's the next question. Can investors beat the market? This is another debate that is hotly contested amongst different investors, what community of investors you might be speaking with. The facts is that most professional investors can't beat their underlying index. So, for instance, if you look at Wall Street, if you look at people who, let's say, manage mutual funds of different stocks, many of those mutual fund managers, after fees, can't beat the S&P 500. Most people would say, well, then you shouldn't try to beat it. You should just basically invest passively in the underlying index, such as the S&P 500, because it's a lot easier to do. You don't have to do your own stock research, and you know that you're going to pay very little fees because the investments aren't being changed every 5 minutes. So by simply replicating an asset category like the S&P 500, it's going to have low turnover, which means fewer trading, if any. and lower administrative fees. And it's going to maximize your return under those circumstances. But here's the irony. When you compare the performance of, let's say, the actual S&P 500 versus something that's been mathematically adjusted by what's called an equally weighted index, the difference is that when you look at the S&P 500 itself, you're going to find that, let's say, the top 10 holdings of the S&P 500 will represent 40%, yes, 40% of the actual value of the stock market as measured by stock market capitalization. So when you look at the number of shares and the price of each share of these 10 companies, represent 40% of the total index as a whole, but it's only 10 companies. Why is that? Here's why. It's because many of those top 10 investments have significantly outperformed the market. And so they have a much more significant bearing or weight within the index itself than does the individual stocks that actually comprise the index. So then the question is, can you beat the market? Well, maybe you can, maybe you can't. But if you want to attempt to have a superior investment experience or a superior investment return, or at least a more knowledgeable approach towards just trying to randomly duplicate what the market does, you will need to invest in those individual stocks or securities in the underlying index that are more likely to succeed than the remaining 490 stocks that make up that index, right? Well, this is where people get kind of, I don't want to say confused, but lost, because that means they have to do some homework. Well, you could actually just take a look at what's the top 10 holdings in the S&P 500 and put more of your money in those 10 stocks. Maybe that's the easy way to do it, but that's not really smart because you haven't done any research on those particular companies. Those 10 companies that may have outperformed up until now may not necessarily outperform later. So what you need to do is to be able to have, or the ability to do some critical research on the investments that you might try to select to be able to have a superior portfolio. Now, the difference is that individual stock prices are driven by a combination of things. This is the other thing where people get confused. You have to have the ability to weed out the noise. And the noise, by what I'm referring to the noise, is the recurring, ongoing, and ever-shifting changes with news headlines and media narratives about what's happening today, what the stock market is doing now, and whether or not it portends some sort of imminent catastrophe within the foreseeable future, versus what is the reality over the course of time as to the operating performance of any company itself in terms of what it makes for profit and whether it's still able to grow profits despite the daily headlines. Headlines are noise. Investing in individual securities within an index that might tend to outperform requires some research on your part. But what we do know is that investing in individual securities, because of that, takes more work. And this is where people become increasingly confused because there's almost too much information for people to evaluate. And a lot of that information is subjective rather than objective. So the subjective information is the onslaught of daily news headlines and media narratives that you read about or hear about on the news that only have a temporary or short-term effect on what the market prices are. What's more important to the selection of a superior stock than day-to-day events is to be able to evaluate any particular stock that you choose based upon its existing profits and expected growth in profits. Over the course of time, especially long periods of time, measured in years, not days or weeks, is that the performance of any particular stock will be based upon its profitability. Newsflash, you want to pick stocks that have the highest profitability. Duh. But people get distracted along the way. They get distracted by so much hype and so much pressure and so much saber rattling over things that don't even matter over the course of time, which is what drives the stock, is profits. So you have to make crucial distinctions. Let me give an example of what I'm talking about here. I'm giving you like a I'm going to give you a daily example of what I just read about today, let alone, one day from the next. This is just within a matter of hours from when I woke up this morning until about maybe a few hours ago. So here are the headlines as published by Barron's today, just over a 2-hour period. I kid you not. So 3 hours ago, the major headline pronounced by Barron's was, quote, market rebound gathers pace as stock futures rise. That was what was published before the markets opened, and the futures were suggesting an increase in performance before the bell. And then 1 hour later, when the market opened, here's the next headline. Dow falls as stocks head lower. What happened within an hour to change that? It's ridiculous. You know what happened? I'll tell you what happened. There was an employment report issued by a private company that said what they found is that for the month of October, that there was the highest amount of layoffs within the workforce since 2003. Now, what you have to understand is that in this environment where, as you know, the government shut down, they're not providing ongoing statistics or data in terms of employment or much else, because there's such a lack of this information. People are gravitating towards this subtle, normally it would be hard to follow, would be obscured by everything else, but because of the lack of data, this one small piece of data is being magnified into something that is bigger than what it actually is. It's like putting a magnifying glass in front of a zit to see how ugly it is. It's not really as bad as it looks on the surface. But people don't know that. They just react to this news onslaught that happens that they can't really put into the proper context. And so what do? An absence of knowledge, an absence of being able to have context about that relative to the situation at hand and the big picture. They overreact to noise. This is a perfect example of noise. This is a perfect example of how you don't want to make decisions about investing, where people will panic, sell, or buy the wrong stocks because of similar information. You want to be able to do research that is based upon facts, not stories. Now, even though it's a fact that maybe layoffs have increased, that doesn't necessarily mean that NVIDIA is not going to make its profits next quarter. You see the difference? But people are selling NVIDIA as if they won't make profits next quarter because there are too many layoffs. Well, what does that have to do with the price of rice in China? Absolutely zero. And what happens, it's like a stack of dominoes where people think, well, if employment is worse because people are being laid off, that means people will have less money, people will spend less money, and there will be less profits by these companies in the stock market. But that's not true of all companies. It might be true of some companies, but to what extent, we don't know. And even if there is any significance, it's not going to affect each of these companies equally. But when you flick one domino and it falls, then all the other dominoes tumble in a cascade just because of that one small impetus. And then you have a magnification of something that's beyond what's real. That's not how you pick stocks to buy and sell. You pick stocks to buy and sell based upon their operating performance, their management, the success of their company, their overall business strategy, the products and services they provide, how competitive the company is in terms of its industry, where it sits in terms of its leadership, where it sits in terms of its innovation, where it sits in terms of the monetization of these different products and services, and of course, what it makes for profits and what it's expected to make for profits. How do you do that? You have to research each and every stock that you consider. Now, for a lot of people, that might seem an overwhelming premise. You don't necessarily have to be an expert to invest. If you'd rather not do that, don't buy the index, right? Because at least that way you'll know that you'll match the index. And over time, like as demonstrated by that Ibsen chart, if you hold your investments for an appreciable time, they should tend to do better. But if you want to try to do better than the market itself, you have to do some homework. And here's the other thing. The homework that people do when they invest depends on whether they're investing or trading. But when you invest, what you want to do is you want to understand each of the companies that you either invest or sell if you own a company that you bought in the past and it's not doing well, or it's not doing as well, or its business parameters have changed that it may not do that well as it has in the past, then you want to be able to understand the financial mechanics behind this. But the problem is that most people who invest in individual stocks, maybe half or less of them actually understand accounting. So how do you understand whether a stock has a good financial profile, whether it's in great financial shape, versus whether it's in a compromised position? This is where you have to be able to understand the differences of accounting that make a crucial distinction between the valuation of a company, how valuable it is, how worthy it is as investment, or maybe it may not be, or it might be more risky, or it might be more speculative because you're investing more so in the hopes that it might improve versus whether it actually does improve. So you have to understand the financials behind the company. And of course, there are 3 different financial reports that summarize a company's financial condition, which include the income statement, balance sheet, and cash flows. Now, income, people think if a company makes a certain amount of income, that's exactly how much cash they have in profit. That's not true. Income profit, as measured by generally accepted accounting principles, is based upon a lot of abstract conceptual ideas that have nothing to do with cash, which include accruals, such as accounts receivable and accounts payable. What that means is that if a company makes a sale, it's not necessarily going to get the money for that sale up front immediately. In fact, it rarely does. It may take as long as 30, 90, or even 180 days for the buyer of that product or service to make payment on that sale. So they're not getting cash necessarily. They're getting basically a promise to pay within 90 days, for instance. That is an accounts receivable. Likewise, companies, when they buy something to pay for an expense, they may not necessarily pay that expense upfront in cash. They may pay it as a bill to be due within 30, 90 days, etc. That's a payable. Also, income includes abstract ideas such as depreciation and amortization. So if a company spends, let's say, $500,000 on, let's say, some production item that goes into their product, they may not necessarily expense that item up front because accounting requires the fact that, well, if this component goes into your product that should last for 30 years, or if it goes into your physical plant or manufacturing that is going to be around for a long time, you can't expense that entire amount up front. You have to actually divide it into a ratable period over which it has a useful life. So if they pay $500,000 for some manufacturing process, that's going to last, the manufacturing process is going to last maybe, on estimate, 10, 20, or 30 years. They can only take 1/10, 1/20th, or 1/30th, depending upon what the depreciation tables may indicate. So in other words, the IRS has certain standards to say if you buy this manufacturing device and it has a useful life of 10 years, you can either elect to depreciate it over 10 years on a straight line basis or accelerated basis, but you can't expense the whole $500,000 now. So profit itself, when you look at the profit of a company as reported, when you hear of quarterly reports coming out for XYZ company and a report, X $100 million or a few $1 billion in profit, that's not necessarily cash. And so what happens is you have to compare what the actual income statement shows versus what the operating profit is in cash. And what you have to do is to reconcile the difference of non-cash items from the income statement to determine what the actual operating cash flow is. So you can be profitable on paper, but you might be cash poor because you may not have enough cash on hand to pay your bills. So that's why it's important to know the difference between income and cash flow. And the balance sheet is kind of like a reservoir of these transactions and activities that distinguishes what has been created as an asset versus what's due as a liability. And if you take away what you have versus what you owe, that's the book value of the company. And so here again, this distinguishes the financial health of a company because obviously you want to have more tangible assets than you have bills. And you want to be able to make sure that you have enough short-term assets on hand to pay your short-term bills when they come due. You also want to be able to evaluate the debt structure of the company. How much debt is being used to finance these capital expenditures? What percentage of it is to assets during the course of time? Like if you look at the cash flow statement, you look at during that period whether there was debt that has been issued versus repaid and what's the net. So it's important to understand where the money is going, how it's being used, and how it's affecting the actual financial health of the company. You only can do that if you understand accounting. If you understand income statements, cash flows, and balance sheets, you can evaluate this much more effectively than the average person who doesn't. And you evaluate these trends over a period of time to review the financial health and the creditworthiness of any of these companies. So that's a very foundational ability to have in order to pick individual stocks. But you know how many people pick individual stocks? They have no knowledge of accounting. They actually use different types of data that's based upon prior price history. In other words, they use what's called technical analysis. So technical analysis will show you price patterns of a stock for previous periods of time that you can infer many different observations from based upon its past price movements. So you have things like moving day averages, which will depict what the stock price has been on average over a period of time versus the actual value. You can look at the day-to-day performance and look at a pattern over time to see whether that stock price has been increasing. So they look at that as a candle. A day's variation in the price is the length of the candle. And if the candle is green, that means that it went up. The candle is red, it means it went down. And of course, you have the range of the price during that day. And based upon a very arcane combination of these technical observations, many people don't understand accounting and think that this is actually more worthwhile to use to select which stocks to buy and sell. Here's what most people don't understand about that. And it's one of the biggest myths that prevail, not only among individual investors, but even some who favor technical trading on Wall Street, is that it's a very simple concept, which is absolutely true, is past performance is not an indicator of future results. So why is technical analysis used at all? Because people have faith in it as an investment narrative. Going back to what I said originally, people favor narratives, subjective information, stories, anything that doesn't involve crunching numbers, because God forbid you have to do any math, right? Math is not important, but charts and appearances are everything. And so when people try to make sense of all this nonsense, I don't consider anything different than financial astrology. It's like reading tea leaves. In other words, what chart could have told you what happened today between 9 a.m. and 10 a.m.? There's not one damn chart available that could have told you that the stock would have opened higher but quickly declined because of an employment report that suddenly a certain percentage of investors started to focus on to make their investment decisions with. It had nothing to do with that damn chart. So it's ridiculous. And this is the difference between investing and speculation. People are making guesses based upon things that don't matter, and they're making decisions in the short term that are less reliable, less predictable, and more likely to incur unnecessary errors in terms of the stocks that you decide to buy or sell, because it's not based on reliable information. Whenever you do that, or whenever you have a stock that has no solid financial foundation, in other words, it might have a business, and it might even be generating some sales, but it's losing money because it's not generating enough sales to cover its expenses. But you want to buy this anyway because you think it's the future. You think it's the future, whether it relates to quantum computing or nuclear facilities, nuclear energy. And most of the companies within these industries haven't even been able to demonstrate a profit, let alone a revenue stream. Okay? And I'm not talking just accounting profits. I'm talking, more importantly, cash flow. It's negative cash flow. It's bleeding money. And yet people will still speculate in these investments because they hope, they wish, and they think they can make a fortune by picking the next quantum computing stock that's going to break out on the charts. Well, good luck to that. You might as well go to a casino. Investing is not going to a casino. Investing is picking investments based upon solid fundamentals. You hear me? Solid fundamentals. So if you don't understand accounting, at least go with a reliable index fund, an index of investments that you understand what they are at the very least, and have a track record of demonstrated performance that's consistent with knowing that stocks outperform because they generate profits versus investing in something blind that you have no idea what will be, not even next week or next year, but let alone tomorrow, and hope that you're going to make all of a sudden an infinite profit by just being lucky. It's not going to happen. All right. So this is all a matter of human folly. You have to overcome human folly by having knowledge and understanding. Here's my underlying advice to you. Okay. You don't have to be an investment expert. You don't have to know everything about investing. Hey, you know what? Even me, there are things about investing I could brush up on in terms of my knowledge and techniques. Maybe I might know more about stocks and bonds than I do about futures and commodities. And I understand, something like cryptocurrency well enough to know that it has no value to it. Real estate, well, I'm not interested in actively managing properties. I'm not interested in landscaping. I'm not interested in making repairs every several months with unexpected expenses that I'd rather not spend money on. I don't have any of those problems with stocks and bonds. So I know that I have a bias towards stocks and bonds because I know most about them. They require the least amount of work in a way of physical labor, or I don't have to pay anyone for that physical labor because none of it exists. I'll have to do my own homework. But if you don't know enough where you feel confident to do your own homework, guess what you can do? You can guarantee that you have a more sound plan by working with an accredited financial advisor, someone like myself, a certified financial planner, who can become your money doctor. I can help you based upon our conversation, a personal conversation about your needs, your goals, your concerns, what you're trying to accomplish, what you're trying to avoid. Great. Thanks for sharing that with me. I appreciate your candor. But with that knowledge, let's make a structured plan that's matched by knowledge and experience that can help you. I can help you to develop a solid investment plan that incorporates the fundamentals of investing, the most successful investment principles as defined by research, including Nobel Prize-winning research and research that I actually can do with what I know as an accredited certified financial planner, knowing how stocks are appraised, bonds as well, to help you structure a portfolio that can best meet your expectations for financial success. And what's better is that not only do you have a plan that's based upon knowledge, discipline, and structure, but we also have the capacity to review that on an ongoing basis. Life changes, you change, things change. Likewise, we can recalibrate our strategies accordingly. That requires ongoing communication. It also requires ongoing trust and confidence. So knowing this and, getting accustomed to the idea of what a financial professional can do for you, this is why I suggest reading this manual, What is Financial Planning and How It Can Help. This can give you a great insight in terms of what I do, how I do it, and how I work with people like you to develop a sound basis for moving towards your financial goals. The biggest catalyst of that is going to be your investment portfolio. And you know what? There are many of these things on my list of items that I mentioned, including stocks, bonds, even commodities, some real estate that I implement with my clients, and also alternative investments. We'll talk about that later, because alternative investments deal with a lot of the more obscure or unpredictable categories of investments that are best done by experts in those fields. But we'll talk about that next time. But that can also become a basis for your portfolio too, one way or the other. And I can work with you to give you more stability, more consistency, more insight, and greater confidence towards achieving your financial goals. So all this being said, I hope this presentation, this podcast has been helpful for you. I'm always here for your input and questions, feedback, and be sure that you like the video and subscribe to my channel, because if this conversation has been helpful for you, you want to be notified every time that I come out with a new video. And also by subscribing, and the more people show interest in the video in terms of subscribers and also the number of times the video is viewed by people like yourself and maybe your friends, the more people this message can reach. I'm here to help. So with that in mind, I wish you a good day and thank you very much for your attention.